So, hi everyone. I'm here with Sarah Davies today, and she's the Chief Data and Analytics Officer for Nova Credit. So, Sarah, thanks very much for joining me today. Really appreciate it.
Thanks for the opportunity. I'm looking forward to the conversation.
So a little bit about Nova Credit, really. I mean, you guys have been operating in the market for a while, and particularly around the acquisition side of things. But what are you hearing in the market in terms of acquisition volumes and sort of activity in the market, where you guys have got presence at least anyway?
So, as you say, Nova Credit is we are a first-party credit data bureau structure for consumers that are traveling from one country to another. Our product is essentially to bring the consumer's credit file from their home country to the new country that they've arrived. It's a product that's perfectly set up for acquisitions. Our second product, Cash Atlas, is focused on bank data. And so for consumers who don't have much data, how do we, again, in an acquisition sense, supplement whatever data they may have, whether it be no data to a very sparse file, and bolster that data with bank data insights, very similar to the sort of open banking construct in the United Kingdom. A lot of our conversations are really focused around acquisitions and how do you deploy these kinds of tools. If we'd had this conversation maybe 6 to 9 months ago, it would have been pretty different to the sort of the kind of conversation we're having now. 6 to 9 months ago, we were sort of rushing out of the pandemic, and almost every lender and fintech that we were talking with, wherever, UK, US, or any country, were talking about how quickly they could bring on tools such as these, new data sources, new analytic techniques, because the focus was universe expansion. How do you kind of really grow the market and take advantage of what was, I would say, pent-up demand from the consumer side? Where we are today has meaningfully shifted, which is, most everybody is simultaneously trying to sort of balance that whole strategy of universe expansion with recession planning. What do we understand about what's going on in the market? What do we see in terms of recession variables? And how do we plan for those components at the same time without sort of, let's say, losing an opportunity, losing a window? So it's a pretty complicated conversation that's going on right now.
Sounds like you're seeing a little bit more hesitation coming in terms of I definitely heard around pent-up demand, but it sounds like people are holding back a bit. I mean, I suppose it's that sense of uncertainty, isn't it? Let alone economic indicators potentially.
Yeah, it's exactly that word, uncertainty. I mean, inflation in the UK, what is it, 9%? But you also have incredibly low unemployment rates. So you've got sort of this tension here with what's going on, and so people are just like, okay, what are the drivers here that we can control? What are, let's call it, COVID effects, and then what and how do we sort of continue to monitor this environment?
And one of the things that was quite interesting about the pandemic is kind of like a bit of a universally accepted experience. Like we all went through it. I mean, almost like on a global basis, didn't we? I mean, do you see differences in the approach to acquisition by market, or is that also because we had this shared experience of the pandemic? Those are pretty common themes in terms of pent-up demand and then hesitation to get back, really because of that, I suppose, post-COVID recession to a certain extent.
And without being, let's say, too cynical, maybe bringing back my British heritage, I think lending is lending in some ways. And so, there have been a few sea changes and in terms of, let's call it, consumer receptivity to digital, consumer receptivity to consumer permission data. But fundamentally, the practice and process of lending has remained pretty consistent. I think one of the challenges as a result of COVID, that while we all went through it, what we see in different markets is different levels of, let's call it, the aftershock. So, in terms of the data and the history that drives so much of the tools like credit scores, that are used to lend, how much of those tools are, let's call it, affected and a little bit skewed or biased right now. So different countries will have different levels of that going on. And I think the key really at this point is to make sure you understand the magnitude of those effects embedded sort of implicitly within your system before you end up sort of going ahead and lending.
Yeah, and I suppose what are the approaches? Because I mean, you're right, it's changed to people like, depending on how the credit bureau got reported, it could affect your credit bureau stats, which was quite heavy in previous models, those kind of things. What are the approaches people are taking? Because previous history, at least as it was reported, isn't necessarily what really happened, nor necessarily being a predictor of the future as well.
I mean, that's exactly right. And, if you overlay then, let's call it, new product disruptions with like buy now, pay later, like that. So I think what that's doing is it really is creating an important window for new data, which is where again, sort of, I mean, in the UK, you've had the open banking infrastructure in place for a while now, but the relevance and importance of that data, especially in the notion of its recency factor, the fact that it's sort of concurrent with today, that data becomes incredibly important for getting a read on the way the consumer is behaving in the immediate. I don't think it replaces credit data. I think the two of them are actually a very strong partnership, but it certainly now says you must have both sources of information.
But do you think we've lost a little bit of the linkage between the bad rate, as we would say, in terms of like the fact you have these events and the fact that those bads or the negative effects or the things you were solving for didn't happen because of stimulus, if you see what I mean? So it's almost like those ratios don't quite work the way they used to. So I mean, people looking at proxies, or I mean, even with open banking data, you're going to have some of those issues potentially, and when it's very short time period.
You have put your finger, I think, on, let's call it, I think, the hidden weakness in the credit system right now that aren't too many people aren't quite talking about, which is, yes, the bad rates, that the history of people defaulting, which fundamentally drives what a credit score value of 660 means in the industry. That right now is questionable, and it's questionable across different countries and different products, even within the country. So yeah, we are in kind of unknown territory, and frankly, we will be for several years yet, because it's going to take a little while yet for credit scores to catch up with, let's call it, more accurate bad rate information. So that's a problem, but this is where you do bring in information from, let's say, the cash flow side, which is affordability. My argument for saying you can't have one without the other is credit data is your first order driver and insight into whether or not somebody will pay, right? Did they actually pay? That's the data recorded in credit files. Bank data will say they have sufficient funds to pay. Right now at this window, you've really got to sort of look at both of these, recognizing that likelihood to pay is likely skewed. So you've got to sort of revert back to this idea of does the consumer have affordability, and work from there. But it's a tenuous, little bit of a tenuous environment, I would say.
The other kind of theme that's out there is also like this we're all in this world that's accelerating all the time, and sort of credit bureau data is typically usually reported at the end of the month, so it's usually like 30 days out of date, or it might be 60 days out of date, and then you've got open banking that's now much more shorter time periods. Are we in this like accelerating time frame? We're trying to get much more sort of real-time data, and does it really make a difference, I suppose, for lending, do you think?
We are in an accelerated time frame, and I mean, I would love to see credit data get reported on at least a weekly basis. The notion that we're waiting 30 days, maybe even as long as 60 days every now and again, is not really working for us anymore. And we saw this sort of value of recency right at the beginning of the pandemic, didn't we? With suddenly, such strong, huge unemployment issues. And there was a huge demand for verification of income. Did someone have income coming into their account the last 2 weeks, the last 4 weeks? So I think we do need to get back to that notion of how can we get this data. Frankly, how can we get access to, let's call it real-time versions of this data? And then not all data is equal. So it's also super important to make sure that we then do a process of understanding what to include at what time. But I think we're actually fundamentally moving in this direction. We're in the growing pains, quite frankly, of a sea change in the industry.
And you mentioned before about open banking data, but it also feels, the other trend feels like there's a lot of extra data that's now becoming available, and people are looking for new data sources from everywhere. Almost to a point, I suppose my question is like, how do you sort of work out what's important versus what's not, versus things that really could be indicative? I mean, because it feels like it's exploding and there's so much out there. It's like, how do you make the choice?
There is now, and what's interesting is, I mean, I've been in the industry 3,000 million years. 10, 15 years ago, we on the US side were pushing to get bank data adopted, rent data, mobile phone information, and there was huge reluctance to engage it. But we're at that tipping point now where it suddenly is like the door is open, and all of this data is sort of coming.
It's a flood.
It really is a flood, and so that's great. In one sense, and it's appropriate. It's time, for goodness sake. There's been way too much intransigence, I think, in the industry. The question, though, is really important about what data is stable, what data is predictive, and you've got to go back to some first principles. So credit data will always have, a very strong place in the center of credit risk management. As I said, it's the first order insight. Data that becomes, let's call it, less connected to the consumer's decision choice of what they did with their money in their account becomes less relevant. And that's where you have to have some really strong, I think, regulatory guidance around it and governance principles and stuff like that. So, looking at pieces of information like preferences for particular types of homes and vehicles and stuff like that, you sort of have to hold that as a third order effect, I think, in terms of credit risk management. It has lots of value in the marketing side of things. But this is where I think, you look again at solutions. When Novo is bringing over a credit passport, we're bringing the core credit file over from the consumer's home country. That data is highly indicative, and we've got analysis on that to show that it will be very indicative of what a consumer will do in their new country. Bringing over their cell phone bill and how many times they touched apps, which we've been offered that kind of data, becomes much more unstable and concerning, I think, in terms of credit risk.
I suppose if you get in the credit bureau data, you're getting sort of like the 80%, and you're just missing that sort of like, the 5-10% on top, the nuance on top, but you get in the vast majority of it, which is probably good enough in that situation to make a decision.
Yeah, I mean, one of the things we've done, again, back to sort of the value of open banking data, is the analysis we've seen and we've done shows that overlaying cash-based insights, so some how people are managing their bank account, can improve predictive power over a credit score by 20 to 40%. So it's for certain credit tiers. So it's really significant. And again, I think at this point in time, it becomes super essential that we start to bring in let's call it other dimensions of data. It's just not open the floodgates to everything.
It's been a big topic here in the UK, and I believe it's been a big topic in the US around transparency of decisioning and transparency of throughout the modelling process as well. I mean, how much of that do you think is going to get resolved? I mean, it feels like that's been an ongoing process with the regulators, and so making sure consumers really understand decisions, but then you have all these mathematical techniques that probably is predictive and makes it even more predictive. So it's sort of like a dichotomy there to a certain extent.
It's a good question. I know the regulators have tried hard to, certainly, in some of the US work and in the UK with sort of the affordability insights, try to hard create transparency. There's a difference between, let's call it, the complexity of the math and the capacity to communicate it. And I think I don't know that there's too many entities out there that are concerned about the giving away so much of their secret sauce that they lose their competitive value proposition. But the capacity to communicate this stuff is very complicated, and we've yet to really crack that nut. I would be, a fan, and I have worked building credit scores in the US for over a decade. We would share the entire algorithm. But is there receptivity and capability to understand through the communication that we offer? That's where I think we need to up level our skills.
And we talked a little bit about people moving to different countries. Now, I lived overseas and sort of gone from one place to jurisdiction to another and struggled to get credit. I mean, are global moves still happening, especially after the pandemic? And are people still facing the same problems?
It certainly came to a screeching halt. We have seen in the last 9 months, especially, a lot of that backlog come back through the system. So people are sort of caught up. And I think in the UK, we're seeing, travel sort of rates within 10 to 20% of pre-pandemic. So it's really picking up quite fast. And in the US, similar. In fact, if anything, from certain countries, the trajectory is increasing. So I think there's definitely a return to the travel sort of component. I think one of the interesting intersections here again, though, is what came out of the pandemic, which was remote work and hybrid. And so now you don't necessarily need to be traveling as much, and you don't need to be doing as much global travel. So we're still, I think, waiting to see the impact of those sort of dimensions interacting and playing out and getting to a steady state. But we're definitely catching up. And definitely people are beginning to see, again, have those challenges in terms of getting access to credit.
What do you see as the future of that? Do you think it's going to go back to the way it was, or do you think it's going to go, continue to grow in terms of because we've become this very globalized society, haven't we? And it's even if I look back to almost like 20 years ago when I was doing it, even more so today, where we're traveling way much more and we're much more global. And I think almost like these video calls have almost like made it even more so. I mean, we're talking the other side of the Atlantic. I mean, it's so easy these days. And I just wonder is that going to suppress travel, or do you think it actually might encourage it? Because people then want to go and work in the countries or in the companies that they've been talking to.
I think it's probably going to be the latter, actually. I mean, the freedom that we get with a Zoom call or a Microsoft Teams capability says, we can now go live anywhere in the world, and we'll just connect in. So I think people are and will be continually taking advantage of that. And so I think, again, we've got to get through the current blips with, the aftershock effects of COVID and the pandemic and some of these, world events. But once all of that happens, I think we'll see much more travel, and we'll see a freedom. And it's already sort of happening within the millennials and the Gen Z sectors. So you're just going to see this sort of branch, deepen and deepen.
Yeah. So when you travel, it's very real in terms of trying to get access to credit. I mean, do you think that's still an issue? Do we need like a global market in terms of understanding, for example, credit bureau data or payment data? Are we moving towards a global market in terms of almost like lending to a certain extent, which is I know you're kind of facilitating some of that, but is that the direction you think we're going?
I think ultimately, yes. We're a ways off of it. The whole idea of cross-border data transfer has to begin with an acceptance and adoption of the value of consumer permission data, right? The essence of Nova's products require us to sort of engage with a consumer permission sort of signal, where you're asking the consumer to actually move their data to choose to do that. And so that requires the consumer levels to sort of be educated and kind of grow in their sophistication of managing their data and stuff like that. But fundamentally, yeah. And I mean, if we took a step back from all of this, there's no good reason why somebody's data can only be within their one country. I mean, fundamentally, it's their behaviors and their interactions with a lender. We should be able to move it across borders. We should be able to transform it into whatever sort of country interpretation and stuff like that.
And when you look at credit bureau reporting in the different markets, do you find are there a lot of differences in terms of like how it's reported, almost like at the technical level, in terms of like, I suppose, approaches, and what are those kind of differences that are material?
Yeah, the answer, probably the best answer to that, unfortunately, is yes and no. So I think if you were to look at the skeleton of a credit file report in any country, and I think we're sort of integrated with like 20 countries at this point, the actual skeleton is very, very similar. There are the trade lines or accounts, there are inquiries, there's sort of the public record information, the severe derogatory information. So you have all of that similar structure in place, regardless of whichever country you go to. Where you see nuances is a little bit in terms of the product types. So, we actually were just doing some integrations with India, where we're starting to build in buy now, pay later capabilities over there. And in other countries, we don't have that stuff. So you see product type, a little bit of nuance and variances. And then around the sides of the data, in terms of the core credit data, might be very, very consistent. But some bureaus will include employment information. Others will include some more information about home address and stuff like that.
And when you migrate it between different countries, do you have to strip out the added bits? Let's say buy now, pay later was included and it's not included in another market, then you have to almost like recombine it? Or is it just, you can just take the whole file?
We do what we can. We have a core sort of standardized format, which is sort of is designed to capture as much of the credit insight as we possibly can. So where we have products that might not exist in one country but do in others, we don't necessarily strip them out, because if there's a certain dominance or presence of that product in the home country, you want to capture that because it's also embedded in the scores as well. So we do what we can to keep as much information as we possibly can. Information that's either not usable from a regulatory perspective in the inbound country, or has, let's call it, it's on the file for an extended period of time. The UK has a certain structure around how much of its data can remain on the file. So we sort of adhere to that paradigm in terms of sort of most of everything we try to keep in place.
I mean, how far do you think the credit bureaus are going to sort of standardize it between the different markets? Because you've got a couple of big credit bureaus that are sort of like getting to like almost like global reach to a certain extent, and then in other markets you have like local credit bureaus that are sort of dominant and those kind of things. And there's a sort of kind of diversity, but it seems like there's been almost like a trend over time to probably the larger ones are being sort of consolidating to a certain extent. Do you think that's going to continue, or do you think the local ones are sort of like going to be strong, and then you've got these new pop-ups of almost like new, smaller, sort of more nimble kind of sources of information as well?
I do think. I mean, look, you've got Experian, TransUnion, Equifax, Credit Info, and CRIF. You've got those 5 very strong players across the globe. And yes, they are incrementally absorbing or partnering with local in-country bureaus. And the value of that is you see a more standardized data set. You see, let's call it more consistent sort of information quality and things like that. Where I think we're going to see a lot more of these sort of data startups, data pop-ups, will be on the consumer permission side. So some more of the alternative data type solutions that ultimately have a strong likelihood to be absorbed into the infrastructure. But to the extent that we can bring in, let's call it new data that might be more on the consumer permission side, that's where I think you see more localized activity. We see, for example, a lot of mobile phone kind of information shops, both in Asia and in Africa, because they don't have the infrastructure of the big data banking structures. So you'll see that come up. But ultimately, I think if we can transcend, let's call it the bureaus having complete and sole ownership of the data and get to a consumer permission perspective of the data, then I think you end up with a much broader consumer passport of their data that really does travel with them everywhere. And that's, I think, the very exciting direction that we need to head.
And I suppose there are some markets where the bureau data isn't quite as strong, right? So you mentioned a couple of the big bureaus there, so that they have strong presence in many markets. But there are some markets, I imagine, where it isn't quite as strong. I mean, how much of an opportunity is that in terms of like building that and building consumer credit in those markets, or even people coming in from those markets to other markets and sort of like, but then be able to access credit because they have to start again, I would think.
There's definitely some countries where there isn't as much of that data. And you certainly see a number of companies that are creatively building new solutions using, and I would say where that often plays, we see that playing out is with sort of again Africa, South America, with mobile data, telephone data. How are phones being used? What's the payment structure around those things and stuff like that. So there's a lot of inference off of that, and I believe that's working very, very effectively for these institutions. The challenge will become when you want to try and normalize that onto, let's call it the global stage of credit. There's an awful lot of there's a big leap still yet to go between that kind of data and the more conventional credit data and what is becoming conventional bank data. So lots of interesting data sources. I think the draw that we have to or the line that we need to draw is what additional data can truly shift the industry, and that I think is cash data, bank data, and you're seeing that become quite prevalent across the globe now.
Yeah, I mean, open banking's been on a tear, certainly over here in the UK, and sort of increasingly across Europe as well. I mean, it's sort of even since the pandemic, right? So it's like a lot of people got used to it or into the habit of using it.
Yeah, I mean, I think that you've just put your finger on, I think, on one of the really important sort of shifts that occurred through the pandemic, which is we were forced to really engage with the digital platform for our banking, and it drove us to get used to that, to get comfortable with that, and to adopt that mechanism much more quickly than perhaps we ever would have imagined. So it has only benefits, I think. There's again hidden bias and hidden challenge, but we're moving that direction now, and I don't think you come back from it.
Have you found that, and how's that sort of changed? Versus your previous companies you work for, previous business lives, or our lives sort of pre-COVID to a certain extent. Has it changed? Do you think it's going to change fundamentally differently for the future?
It has changed a lot. We were a company that was based in San Francisco. Our entire, we had one major office there. We had a smaller office in New York. And with COVID, we were trying to hire and literally had to sort of forego this notion of nobody was going to move. So everything now became remote hire. So we now have pretty cool offices in both of those locations, but then people across the country at this point.
Yeah.
I think the important loss that we've experienced is, while we're grateful for the Zoom technology and such, we've lost that sense of community and corporate culture and corporate community. And that's been hard to navigate, I think. So we've had to work harder at process and messaging and communication and engagement and building that relational fabric.
Do you think we can put the genie back in the bottle, almost like in terms of like remote working? We've got people in lots of different locations. I mean, you'd have to ask them to basically move again, right? So
yeah, I don't think we're coming back from it. I think that let me put it this way: we've tried to put the genie back in the bottle, and it hasn't worked. We sort of started to begin to signal we're going to move back to these major office locations, and there just simply wasn't an interest. After 2 years, people have really sort of instantiated themselves in their new locations and the freedoms they have to travel and work from anywhere in the world. So it won't go back, I don't think.
And so what do you think the structures are we're going to have to put in place? What are we going to have to face up to in order just to try and get that community back together again? And some of the things we've maybe lost, and although we've gained some other things as well.
Corporately, one of the things we're trying to do is be much more intentional about, at least now we can travel, getting some offsite sort of experience together for people. So you have sort of a more intense 2 or 3 days of people coming together. That's becoming increasingly important. So I think that's huge. I think then also just being mindful of the fact that when you're doing, let's call it, you're living a Zoom world, you literally are sort of, let's call it, on in terms of your work dialogue from minute 1 to minute 30. And so how do you create that water cooler conversation? Let's go down to the coffee shop and grab something experience. So you've got to work to sort of create a lot of that stuff. I mean, fundamentally, the relational fabric disappeared from COVID with COVID. And that's the thing we now have to reinvent, quite frankly.
Yeah, it's quite intense, isn't it, when you're on a video call, because you're really in each other's face for a while.
Yeah, and it's hard to listen. You've got to be really engaged the whole time and read the signals and all that stuff, all allowing for quite productive work. I think the big fear with this was, we're not going to have productivity, but I don't think that's been the problem at all. I think it's the loss of the enjoyment of work has been what we are sort of really seeing happen now.
So if you were to get your crystal ball out, and you were to say, where are we going to be in 5 years' time, particularly with the lending market, in terms of like growth in the lending market? What do you think the big trends are going to be?
That's a dangerous question, but 5 years' time, I do think we will have, let's call it, navigated through and no longer see transferring data across borders as a challenge or anything unique. I think that the use of bank data will be so fully embedded within let's call it the global lending practices, that the whole idea of financial inclusion and underserved banking, that will go. We will no longer even have those terms anymore. And I think this idea of consumer permission data is going to actually transcend, let's call it, the corporate permissioning of data. So that platform and that consumer paradigm, I think, will make cross-border lending again a pretty standard idea, and really fundamentally kind of bringing a new level of sort of sophistication to the market space, but in a way that is much more efficient for lending and cash management.
It's human lending, really, isn't it? It's about really understanding the human, no matter where they come from, but it's understanding the human, and then giving them the ability to be able to get credit to do what they want to do.
Yeah, I mean, that's exactly right. I mean, you and I have both lived in many countries. In our capacity to it's got to manage our credit change when we got on a plane and landed somewhere else. Well, fundamentally, no, it didn't, did it? So it's actually forcing people to actually get back to that level of reality, bringing some data around them, but But fundamentally, lending should happen regardless of what country you're in or where you've traveled from, because the ethic and value of lending is within us. And that's, we come back. I like what you're saying about human lending. It's good.
Well, it's a fascinating topic. And Sarah, thanks very much for making the time for me today. I really appreciate it. A really enjoyable chat. Appreciated it. Thank you very much.
Thanks very much. Enjoyed it as well.